Welcome back to the Daily Crypto Roundup. Today's market is giving us one of the clearest mixed signals we have seen in weeks. On one side, institutional money is coming back into Bitcoin in a serious way. Spot Bitcoin ETFs have just pulled in more than $2 billion across an 8-day inflow streak, and that tells us Wall Street is not walking away from crypto. But on the other side, short-term holders are quietly selling into the move. Leverage is being flushed out on both sides of the market, and traders are still not fully convinced that this rally has enough strength to push Bitcoin cleanly towards $100,000. So today, we need to break down the real story underneath the headlines. This is not just a simple bullish day or bearish day. This is a market where institutions are buying, weaker hands are selling. Ethereum is suddenly back in the long-term valuation debate, and Washington may now decide whether Bitcoin gets its next major structural catalyst or stalls before the breakout. And just before we get into it, this episode is brought to you by Kraken, our official exchange partner. If you want a straightforward way to buy, sell, and explore crypto, Kraken is well worth a look. It's not financial advice, but if you want to check out the platform, use our link in the description. And remember, we are still running the 20 XRP giveaway, so if you want to enter, use the Kraken link in the description and follow the instructions there. Not investment advice. Crypto trading involves risk of loss and is offered to U.S. customers through Payward Interactive Inc. View legal disclosures at kraken.com. Now let's start with Bitcoin, because this is where the market is most conflicted. The big headline is that spot Bitcoin ETFs have brought in roughly $2.1 billion over 8 straight days. That is not a small number. That is not retail traders on their phone throwing a few £100 into the market. That is institutional allocation, fund flows, professional money, and larger investors using regulated products to get exposure to Bitcoin. And that matters because ETF inflows have become one of the cleanest signals for whether Bitcoin is being accumulated by longer-term capital or just being pushed around by short-term leverage. When ETFs are seeing steady inflows, it usually means there is demand beneath the surface. It means that even if the price action looks messy day to day, there is still a buyer base absorbing supply. And that is the important part of this story. Bitcoin has not exploded higher yet, but the market is showing that real money is stepping in again. But here is the twist. At the same time as ETFs are pulling in billions, short-term holders have apparently started selling. And that is why this move feels so strange. The institutions are accumulating, but some of the people who bought recently are taking chips off the table. That usually happens when Bitcoin rallies into resistance, and traders who were previously underwater finally get a chance to exit. It does not necessarily mean the bull case is dead, but it does mean the market is going through a transfer of supply. In simple terms, weaker hands are selling to stronger hands. That is not automatically bearish. In fact, in a healthy market, that kind of rotation can actually be constructive. If short-term holders sell and ETFs absorb the supply, the market becomes less fragile over time. The problem comes if the ETF inflows slow down while short-term selling continues. That is when the rally starts to lose fuel. So the key thing to watch now is not just Bitcoin's price. It is whether these inflows continue for another week and whether Bitcoin can hold its current range without breaking down under profit-taking pressure. The next big question is whether Bitcoin can realistically make a run towards $100,000. That level is back in the conversation because Bitcoin has been trading near the high $70,000 area, and analysts are starting to argue that the next major magnet could be 6 figures. But the reason this matters is not just because $100,000 sounds good in a headline. It matters because it would change market psychology. It would pull retail attention back in. It would strengthen the ETF narrative. It would make crypto feel like it has survived another major test. But the road to 100,000 is not just about charts. It is now tied directly to Washington. One of the big stories here is Kevin Warsh and the Federal Reserve. The market has been looking at Warsh as a potentially more crypto-literate Fed figure, and that matters because the Fed does not just influence interest rates. It influences the entire risk appetite of the financial system. If the market believes the next Fed regime understands crypto better, treats digital assets as part of the financial system rather than something sitting outside it, and avoids pushing a central bank digital currency agenda, then Bitcoin could benefit from a stronger structural narrative. That does not mean a Fed chair can simply send Bitcoin to $100,000 overnight. But it does mean the macro backdrop becomes more supportive. Crypto performs best when liquidity conditions improve, regulatory fear drops, and investors feel comfortable taking risk. A crypto-aware Fed chair would not remove volatility, but it could reduce one of the biggest psychological overhangs: the feeling that traditional regulators still do not understand the asset class. But this is where the bullish story gets complicated. Warsh's confirmation odds have reportedly fallen sharply, and that adds uncertainty. The market does not like uncertainty, especially when it is already sitting near key resistance. If traders were pricing in a smoother path towards a crypto-friendly policy environment and that path suddenly looks less certain, Bitcoin can hesitate. That is exactly what we are seeing now. The price is holding up, but it is not breaking out with full confidence. Then we have the Clarity Act, which may be even more important for the long-term crypto market. The Clarity Act is being framed as one of the major pieces of market structure legislation that could finally give the US crypto industry clearer rules. That means rules for exchanges, custody, stablecoins, and digital asset classification. And this is huge because one of the biggest problems in crypto has always been regulatory uncertainty. Builders do not know what is allowed. Exchanges do not know exactly where the lines are. Institutions do not want to step into a market where the rules can change after the fact. If the Clarity Act moves forward, it could give crypto a stronger foundation in the United States. It could make it easier for banks, funds, companies, and investors to participate without feeling like they are walking into a legal gray zone. That would be bullish not because it creates hype, but because it improves the infrastructure around the market. But once again, the problem is timing. The window for getting it done appears to be narrowing. If the bill slips too far into the political calendar, especially with other issues competing for attention, then the market may have to wait longer for that regulatory certainty. And that delay matters. Crypto can still rally without perfect rules, but the biggest institutional move probably needs more clarity. So Bitcoin is sitting in this very interesting position. ETF inflows are bullish. Short-term holder selling is a warning sign. The $100,000 target is realistic if momentum builds, but it depends on policy, macro conditions, and whether institutions keep absorbing supply. Now let's move to Ethereum because this story is completely different. Fundstrat's Tom Lee has backed a report that lays out an extremely aggressive long-term Ethereum price target of $250,000. And let's be clear straight away. That is not a near-term forecast. That is not someone saying Ethereum is going there next month, or even this cycle. This is a long-range valuation argument based on Ethereum potentially capturing part of the monetary premium currently associated with assets like gold and Bitcoin. But even though the number sounds wild, the argument is important. The basic idea is that Ethereum has something Bitcoin does not have in the same way: staking yield. Ethereum holders can stake their coins and receive a return for helping secure the network. That makes Ethereum more like a productive asset in the eyes of some analysts. Bitcoin is often compared to digital gold because it is scarce and hard money. Ethereum is sometimes compared to a digital economy because it has applications, fees, staking, smart contracts, stablecoins, tokenization, and DeFi running on top of it. That difference is what the report is trying to capture. If Bitcoin is the asset people hold because they want scarcity and monetary discipline, Ethereum is the asset people hold because they want exposure to the infrastructure of crypto itself. It is not just trying to be money. It is trying to be the settlement layer for a large part of the digital financial system. And if that vision becomes real at scale, then traditional valuation models may not be enough. But we need to keep this balanced. A $250,000 Ethereum target is massive. At Ethereum's current supply, that would imply an enormous market value. For that to happen, Ethereum would need to capture a huge share of global value, maintain dominance against competing chains, keep institutional trust, and prove that its scaling roadmap can support real-world adoption without losing security or decentralization. That is a lot to ask. And this is where Ethereum's story gets interesting. The bull case is massive, but so are the challenges. Solana is faster and cheaper in many retail use cases. Bitcoin has the cleaner store of value narrative. Other chains are competing for stablecoins, tokenization, gaming, and payments. Ethereum still has the strongest developer ecosystem and the deepest institutional familiarity. But it has to keep proving that it can scale and remain the main home for serious on-chain finance. So Tom Lee backing this kind of Ethereum thesis does not mean everyone should suddenly expect Ethereum to go vertical. What it does mean is that Ethereum is being discussed again as a serious long-term institutional asset, not just another altcoin. And that is important because Ethereum has underperformed Bitcoin in many periods. It has frustrated holders. It has been criticized for fees, complexity, and slower price action. But when the market starts talking about staking yield, settlement value, and long-term monetary premium, Ethereum gets pulled back into the big picture conversation. And that matters for the entire altcoin market. If Ethereum starts to regain narrative strength, it can improve sentiment across major altcoins. It can help Solana, XRP, Cardano, and other large-cap assets because it signals that investors are thinking beyond Bitcoin again. But for that to happen properly, Ethereum needs more than a headline. It needs price confirmation. It needs volume. It needs ETF demand, staking demand, and stronger network activity. Now let's connect this with the liquidation story because this explains why the market still feels so choppy despite all these bullish headlines. Over the past 24 hours, the crypto market saw around $178 million in liquidations. What makes this number interesting is not just the size, it is the split. Long liquidations were around $92 million, while short liquidations were around $86 million. That is almost even. And when both longs and shorts are being wiped out, it tells you the market is not trending cleanly. It is chopping. This is the kind of environment that punishes overconfidence. If you are too bullish with leverage, a sharp drop can liquidate you. If you are too bearish with leverage, a sudden spike can wipe you out as well. And when price keeps moving inside a range, reversing quickly, and failing to follow through, both sides get destroyed. That is what we are seeing now. Bitcoin alone reportedly saw more than $120 million in futures liquidations while chopping around the $77,000 area. That tells us traders are still using too much leverage even though the market has not chosen a clear direction. And that is dangerous because high open interest can make every move sharper. When too many traders are crowded into leveraged positions, small price moves can turn into forced buying or forced selling. This is why the next move matters so much. If Bitcoin breaks higher with ETF inflows continuing, shorts could get squeezed and momentum could accelerate quickly. That would bring the $100,000 conversation much closer. But if Bitcoin fails, ETF inflows slow, and short-term holders keep selling, then over-leveraged longs could get hit again. That would create another flush before the market finds support. So the real message today is this. The market is bullish underneath the surface, but unstable on the surface. Institutions are buying. Policy could become a major catalyst. Ethereum is getting a serious long-term valuation story again. But leverage is still high, short-term traders are nervous, and Washington is now a key variable. That means this is not a market to treat casually. This is a market where the next few weeks could define whether crypto is preparing for a proper breakout or just another failed rally. For Bitcoin, the key level psychologically is still $100,000. But before that, it needs to prove it can hold the high 70,000 range and push through resistance with real volume. For Ethereum, the key question is whether the market starts to believe in the long-term staking and infrastructure thesis again. And for the wider market, the key risk is leverage. If traders keep piling into positions before confirmation, we are going to keep seeing these liquidation waves. The XRP giveaway winners this week are Moorhead and Andre Legel, who both received 10 XRP each. You've both been nonstop this week, and we do really appreciate it. We've also got Josh Pritt and Campbell receiving 5 XRP each. Congratulations to all 4 winners, and thank you to everyone who entered. Keep following the show, keep checking the link in the description, and we'll keep doing more giveaways for the community. Use the Kraken link in the description if you want to check out our official exchange partner and get 20 XRP from us straight into your new wallet. Thanks for listening to the Daily Crypto Roundup. Follow the show, leave a 5-star rating if you're enjoying these updates, and as always, we'll see you at the top.